Welcome to the Cryptohopper Crypto Trading Podcast, where we help you become a better trader. Whether you're new to crypto or a seasoned pro, this podcast is for you. Tune in to hear from industry experts and check out cryptohopper.com for our world-class automated trading bot. In this episode, our guest is Siddesh Pratap Singh, a crypto trader at Creed&Bear, discussing a day in the life of a trader. Subscribe to stay up to date on the latest crypto trading tips and insights.
Let's start. Fire away, man. I'm more than happy to answer your questions and understand about Cryptohopper and your perspectives. And yeah,
Yeah, so could you introduce yourself a bit? Tell us more about yourself, who you are, what do you do, how you got into crypto, for example.
right, sure. So my name's Siddesh Pratap Singh, as you guys already know, 21 years old. Started in crypto back in 2020. I used to work in a hedge fund called Negma Group, which was a French hedge fund based in France, Dubai, and the US. So over there, I initially started as an equities trader. While trading equities over there, I introduced, since it was the family office, I introduced the office that why don't we start trading in cryptocurrencies? And we already had a very strong quantitative team in Negma. So it was quite easy to replicate our success from equities towards crypto. We had some proprietary trading where it would be less quant side, more information based, and then there were certain trades that were based completely on quantitative methods. After that, I was more into crypto, and Negma was more focused towards equities. So I made a change in my career and moved to Creed&Bear. Creed&Bear is an AI quant based asset manager from Switzerland, and we currently trade and we manage around 500 million USDT assets under management. We do high frequency trading. We do market making, provide liquidity, and try to find arbitrage opportunities as much as possible.
Oh, I get it. It's very nice. So basically, you started as a hedge fund, as an equity trader, and then you transferred. Then you wanted to continue with cryptos, and then you transferred to Creed&Bear.
Correct.
And you yourself make the software, the quantitative software, or what is your position exactly in the company?
So my position in Creed&Bear is a quantitative trader. So most people are just all their positions are basically traders. There's no proper hierarchy, I would say, from the head of trading to the CIO. All of us are basically traders, right? Firstly, and secondly, there's no chain of command kind of a thing. If anybody has a brilliant idea, we just present it, we go forward with it, we have weekly meetings, stuff like that. And all of us are quantitative traders. All of us use algorithmic trading tools. We use a lot of Python, a lot of Jupyter notebooks for machine learning. What else can I say? Some amount of technicals. Two of our traders, one is a girl from Thailand and another man from Iran. They're both really good technical traders. So they present us with technical opportunities, which we implement towards the fund as well. And yeah.
Sounds awesome, and yeah, very exciting to be there every day and to trade alongside other traders and other people who
Right.
know what they're doing.
Right. No, definitely. Definitely. To be honest, I have learned so much from my peers. I'll be very honest. In terms of, because initially, even when I was working in equities, right, my knowledge in terms of technical analysis and stuff like that was always very weak. I graduated as a finance major, and I was more towards fundamentals and more towards my approach was very data driven always. I was not a chartist per se, I'll be very honest. I always had a quantitative data driven approach or a fundamental approach. I never had a technical approach per se, but I learned a lot of technical analysis from them. Initially, I believed it doesn't work, to be very honest, but as I keep seeing their success, I learned a few things from them, which I think personally that do work pretty well. Certain things, because the issue that I've seen in the technical analysis side, and they've told me as well, is that it's a lot of indicators are very lagging, you
Mhm.
see, and because of these lagging indicators, you're not able to identify opportunities. But these guys implement multiple indicators together and use their own experience, and they're able to see from charts what's happening in the market. So it's pretty interesting, no doubt. But me personally, I'm more towards fundamentals or quantitative. Very little technical. I've learned so much from them. I'm very thankful. Sorry.
It's
And yep,
great to have such a diverse team where you can all learn from each other and
correct.
yeah,
Because they have
complement
learned
each
so
other.
much from me in terms of fundamental knowledge, how does CPI work, how does PPI work, how does so we're in such a macroeconomic environment right now, and we have such a strong positive correlation coefficient with the QQQ 100 index
Yeah,
and the
I
S&P 500.
Yeah, I've noticed that, especially lately. Before it wasn't as much, but when Bitcoin is down, QQQ will always open lower, and when Bitcoin is doing well, QQQ always opens higher and has an amazing day.
Yeah, so we see this is where I excel, right? In finding correlation coefficients. I started finding this personally back in January, February regions. And that's when I started doing analysis on correlation coefficients, on co-integration, and on developing a Bayesian regression model. Uh, and that is where a lot of my time goes as well. Uh, to understand data in a way where you're able to use that particular data and enhance from there in terms of predicting or having probabilities to see where the market may head.
mhm.
Sounds very interesting. And do you always employ high frequency trading with quantitative and technical analysis? Or do you apply technical indicators to longer time frames like the 4-hour chart in order to make swing trades?
Correct. So we have certain swing trades that so some information is discretionary. I cannot disclose,
Yeah, of
but
course, no worries.
yep. So, but I can say that certain trades for us can last in futures and Binance futures can last all the way from when Bitcoin was at $55,000. We have certain trades that are open on shorts from that time till date, which are very profitable, very great, and
I
we
can
do take
imagine.
yeah, so we do take certain swing trades that we have high conviction and we notice the probability is higher. So the aim is always to work in a matter of EV, which is expected value, and probability. If we see high probability, high expected value on a trade, we always go for a longer term.
Yeah, so what is important after all is profitability, and it doesn't really matter for you if you are trading short term or long term. What matters is that it works out in the end, because in general, I think there are many trading styles and there are many ways to make money in the crypto market. You just have to find the right one that works for you, and in your case specifically, it is the fundamentals as you're great with that. So, how does your day look like as a trader?
Okay, first things first, step into the office, get some coffee or tea or something. And we have a morning meeting. In the morning meeting, we
Every day.
discuss every day. Every day, there's a morning meeting between the traders only, between the traders and head of trading. And in that meeting, we discuss possible black swans that can occur. The current black swan that's occurring, as we see, is FTX versus Binance, and it's been interesting. So we discuss possible black swans. We're currently in discussion for tomorrow's CPI as well. Where we're discussing the US elections as well. So, discussions basically anything that can impact the markets in a way where it can have a high volatility period. So, sometimes we choose to not trade during these high volatility periods. It's in terms of our HFT algo. We prefer to stay out during these times. And once we feel that it is calmer, our algo is then restarted and then we go back to trading.
Oh, and then you decide all of this usually in the morning meetings.
Always, always.
And
If
how
it's an
long are the night?
emergency, I mean, we have WhatsApp groups. We always communicate on them, but normally morning meetings, and they last anywhere from 15 minutes to 20 minutes. Very short, very quick, very straightforward, to the point.
Yeah, short and efficient, short and sweet.
Correct.
And after your
Correct.
morning meetings, what is your program afterwards? Do you go to your
So
desk and don't
after
forget
that,
because
we
it's
all
more
go.
working?
Yep. Kinda, yeah. We all go to our desk. We all start working on our strategies. Everybody's working on a strategy. Some people work in teams. Some people work alone. Uh, and we all keep on implementing our strategies, back testing our strategies to see if they work. Um, every Wednesday or Thursday, we have another meeting, which is with the CIO, the CEO, and the main people, basically, if we found a profitable strategy that we want to implement. So a lot of the time goes into back testing or theorizing what can and what cannot work. So initially, you're just blankly looking at data for the first hour. And then you start scratching your head towards, okay, how can I do this? Okay, maybe this works. And then we transfer all of that to Python. And then we take it in Jupyter. We look at data in a way where we can clean data. Okay, data looks good. Once that's done, okay, this may work. Once you think, okay, it's giving some probability, then we're going towards backtesting it. Then we start taking historical data, backtest the whole thing, and then, okay, backtest is good. This is good. Let's try to front run it a little bit. Does it have any biases? Does it am I curve fitting? So I would ask somebody else as well that to check my strategy, because a lot of the times we as traders we curve fit just to
Yeah.
make the strategy work. We keep changing it, tweaking it little by little. Once you start doing that, it, it means your strategy actually doesn't work, but you're trying your best to make it work. When you're trying that hard to make something work, it probably doesn't work in the long term, and that's not a strategy that you want to go for. That's one advice that I would give to people as well, because I wasted 2 months on a strategy like that. So, I mean, these things happen all the time.
So
Gotta be
usually when
straight.
you find a good strategy, it at least works all right from the beginning, and then you optimize it into something great. But if it doesn't work in the beginning, you shouldn't like try to spend all the time in the world to optimize it because it's probably just a bad idea in the first place.
You should go for it. I wouldn't say it's trash from the beginning. I mean, you should go for it, but always have somebody else who you believe is smarter than you, or who have a look at it as well, and try to be very less defensive and more open to criticism. That if it doesn't work, he's going to be honest with you and tell you this does not work.
And you are also probably doing some logical analysis. As in, if you see a strategy that looks too good to be true, you are probably asking yourself, does this really work? Or did I just curve fit everything?
To make
Correct.
it
So
work.
so we I had a strategy with it was a technical strategy, and as I told you, I'm not that good at technicals already. So it was a technical strategy that was making 400% on an HFT
In how long?
in, let's suppose, 7 months
Oh man.
approximately. So I got other people into it, and it was basically, since it's a failed strategy, I can talk about it. It didn't work in the end of the day. It was with pivot points, and it uses daily, weekly pivot points, and it causes swing trades to happen constantly. And it has buffers on the top and bottoms of the pivots as well, based on calculations that I did on the backtest. And I believe in my calculations, I may have curve fit a little bit, due to which it may not work. So my point is that sometimes, honestly speaking, working with other people is a blessing, because you have to always understand nobody is an ultimate genius. We all require somebody to always remind us that, okay, is this working or not working? Because something we've noticed a lot of the time is that we as traders become a bit egotistical with or cocky. And which is why I always encourage a lot of teamwork, because we think we know everything, but then we fail to understand or take criticism very well, because we think, oh, this guy may be jealous, or this guy may be X, Y, Z. But in reality, they're just trying to help you. So always try to be open minded, always try to be looking at it in a probability perspective, in a mathematical perspective. I think that helps the most. I think when you look at things in a mathematical perspective, that is why I always tell everybody: if you have a strategy, run it through the data, run it through a backtest, run it through everything you can to give you mathematical data or any data that you can confidently say, okay, this works. Don't just shoot words in there. That's not a good idea.
I had
I
a
mean,
similar
I don't
experience.
know I don't know what your audience is or who are the people who are going to listen to it, but yeah.
No, so basically, we at Cryptohopper, we basically make automated trading easier for people who have no idea how to code, who don't have any knowledge in coding. You obviously know how to code Python, and
Correct.
yeah, you obviously have coding knowledge. But there are a lot of people out there that may be good traders, or they may have to trade manually, but they have no idea how they would code that strategy and how they would automate it. And that's where we come in. We provide a platform where people can easily automate their strategies without coding. So we have
That's
actually,
really cool.
yeah,
That's
we
really
actually have a
cool.
lot of traders that are great at trading but not so great in coding. So it's great to hear from somebody that also has a knowledge in coding himself.
Right. Right. No, I would honestly advise. I don't know. It depends on the age of your viewers or listeners, but I would honestly advise all of you, if you want to get into trading, study finance or financial engineering with computer science. I believe these two combinations work so beautifully if you want to become a trader. I only studied finance. I had to learn Python and everything else myself on my own, and it was very difficult for me because initially I didn't understand anything, but then as I kept doing it within 2 3 weeks, it became quite easy, to be very honest. Python is such an easy language. It looks
Mm.
intimidating at first, but once you get the hang of it, and once you start doing basic tasks very easily, then everything else makes sense, to be very honest.
Yeah, I had the same as you. I knew how to trade based on technical analysis, but I had to learn Python in order to backtest and optimize strategies better, and to be able, to trade automatically on my own, to make my own software. I made my own backtester as well. And by the way, talking about backtesting, how how long is the data that you backtest on? For example, for Bitcoin.
Oh, back test. We try to do a back test every 6 months, and we try to refresh because we notice that Bitcoin or crypto as an asset is so volatile that you cannot backtest it, like for example the S&P 500 that's been around for so many years,
Mhm.
or you cannot backtest it, like for example something like the composite that's been around
QQQ.
for, yeah, exactly. So all of these composites and ETFs, you can backtest them in a very long portional way. But when it comes to BTC, it's a bit different. When it comes to BTC, we try to backtest it within its cycles. For example, if BTC as a cycle has had a bull run, so we'll backtest the entire bull run. If it has a bear rally, we backtest the bear rally, ignoring the price of the coin and rather looking at the percentage change between data, because back then the price of BTC was what, 8,000, 7,000, compared to now where the bottom people think is 20,000. I don't know. Nobody knows. But yeah. So, I mean, they're all perspectives. Sometimes don't look at the price directly, look at percentage change, look at volume back then, how much volume was actually being used comparatively speaking now. Look at black swan events that may have triggered or may have affected prices. Don't just blatantly look at data that, oh, this was the price, X is this, Y is this, we're done. No, look at all the little details that go with it. Why did these big, huge volumes happen? Can you explain them? Is there data behind it? Is there some fundamental behind it? So you have to focus on these things a lot and try to be very articulate when and going through data. That is very important, I feel.
I understand. It's very interesting. So you don't, for example, look from all the data from 2015 until the present. You just go and look at a specific period.
We look at periods and cycles, and then we just keep saving that backtest data. And then we keep using the same backtest data over and over because we've done analysis on that data and we have cleaned that data to the point where we know its actual authenticity.
Yeah.
rather than just price was X, now price is Y equals this. Now you look at it in a much more deeper perspective.
And
That's
how
why
do you
cleaning
actually
data takes a lot of time.
how do you actually deal with the fact that sometimes exchanges change data? I
Correct.
you've probably noticed, but exchanges sometimes change their data to make it look that they're not as volatile. For example, like there were cases of a coin making big moves when it was
Hmm.
clearly manipulated by outside people, and then the
Correct.
exchange deleted all the data.
Correct. Which is actually a small reason as to why we take the 6 month thing.
Mhm.
We did a lot of backtest even on that as to why we chose 6 months. So 6 months, 6 to 8 months is a good time to check data for every time you're doing a backtest. Because if you're checking it outside its extreme, I don't. Let me think how to explain this properly. Imagine a diagram where it has two tails and the middle is going up. So ignore the tail and only look at the data in the middle. That's my point. I don't. If I could draw the diagram, I could probably show it to you in a better way. But yeah.
Yeah, I get it. And in general, what are some do's and don'ts for you to a beginner trader?
That's a tough one. Since I started in equities, it was a bit different because I was focused on a lot of fundamentals and data stuff like that. It depends on what asset class they're going in, right? For cryptos, generally, if you want to get into trading, like with any other trading, start with some paper money. TradingView does it for free very well. TradingView is very good. We all use TradingView even in our company, so you can understand how strong TradingView is as a software itself. First of all, second of all, try using TradingView a lot. Do some testing on that. Figure out a strategy that you think or believe works. Once you understand that, keep doing it constantly. And if it stops working, go back to if you've made any changes and see why it stopped working. Once you keep doing this consistently, as far as we understand, is two things are very, very extremely important. One is consistency, and consistency only comes with how you allocate your risk. I believe most of your traders are retail.
Yeah,
If you're
that's
from
right.
the retail sector, yep. So if you're from the retail sector, for example, not just at the firm, I trade myself as well on my phone or on my PC or stuff like that with my own personal funds. So I'll answer this from a non-institutional perspective as another retail trader. So manage your risk very well. Only trade as much money as you're willing to lose, and I'll always have. I wouldn't say put a stop loss. I never put a stop loss personally in my own trades.
Mhm.
I never have stop losses, but have a dynamic stop loss in your mind that the appetite of risk you can take is this much. If it reaches this stage, I'm out. This is too much for me. I can't take it anymore. Or probably my theory was wrong. My strategy was wrong, and I shouldn't have done this. Always have a dynamic stop loss in place, and try to be consistent. Try to have
Try to have a consistency. And as we're talking about consistency, because in trading, whatever you do, no matter how good you are, you can't always win
Of
100% of the
course,
time.
of course. It's a 7 out of 10 thing there. You win 7 times, that's good enough. Always use the same amount of margin in each trade. Always use the same amount of leverage. Please do not go high leverage. I tell everybody this who is retail or who's new to trading. There's a trick to using high leverage. A lot of these people they go very low margin with 125x, 120x
Oh,
margin
that's just
leverage.
insane. It's
Yeah, yeah,
it,
it's
it's worse than
gambling then.
sport betting.
So this is what I'm trying to say, right? Don't gamble. There is a difference between gambling and trading. Understand that difference. If you want to be in this profession for a very long term and you don't want to burn out, I would suggest everybody to have proper risk management. That is so important. Risk management is your leverage is always predefined. It's never too high. Your risk is predefined. It is never too high. You're trading with money that even if you're able to sleep peacefully at night. Your size is not large or beyond large that you have sleepless nights. These little things will help retail traders become better traders, to be very honest. And if they want to get into institutional trading, start studying computer science, start studying your Python, start studying machine learning, start studying fundamentals, start reading how to do financial analysis and data. And that's when you can step into the institutional side of things.
Very,
Yep.
very interesting. And for example, like what's in a year, what's or in general, what's the maximum drawdown you would allow yourself to have on your personal account or at your institution? Like,
Institution is different, personal is different. For example, okay, for personal account, I don't uh, let any trade go against me more than 20%.
Mhm.
That's my personal max risk. That if it's going against me more than 20%, and I don't go big leverage, sorry, big. So I always use maybe 2x or 3x leverage only,
Mhm.
maximum, and I never let a trade go more than 20%. If it's gone more than 20%, I'm probably wrong.
Yeah, it's
So
it makes perfect sense. And
so 20% is my cutoff. And if you're high leverage, then 20% will become in seconds. It will come in seconds. It will go in seconds.
yeah, but
So
on 2 3x, it shouldn't go that
it
badly
shouldn't go.
unless you are trading FTT and
Yeah,
today.
correct. So 20% is my highest. I have the ability to hold trades for a very long period of time. I try to not close any trades in a loss per se. I have trades which I have held on for 2 3 months, which have turned out to be profitable. Which were initially losing. I also imply a strategy where I call it stab and poke. So stab and poke works in a way where you don't go all in on a trade each time. You go certain percentages of equity. So, for
Partially,
example,
right?
partial entries. Yeah. So let's suppose you entered a short for Bitcoin at 20,500. Price goes to 21,000. So you add 1% equity again. You add 1% equity, 1% equity constantly as the price keeps going against you, because you understand that the end move, according to your data or your analysis, is down. So that's where you're trying to
Like
have partial
you enter
entries.
in very short bursts,
Correct.
and
In
it goes
very
against.
like pokes. You're poking it basically
Yeah,
with a small needle, something like that. Yeah. Again, that has to do with risk management. My
and
entire futures account, 1%, 1%, 1% constantly.
So you're constantly buying more and more when it goes down. But you also do the opposite. So when it goes up, for example, let's say you buy Bitcoin at $20,000, do you sell 1% when the price starts going in your favor? So for example, sell 1% at 20,500, then 1% at 21,000 and so on. Or do you just sell everything at once?
Kind of like that. No,
ah,
I don't sell everything. It's just kind of like that, but it's more towards like 25%. So
yeah,
25%, 25%, 25%, 25%. You start taking profits slowly and slowly, because in the end of the day, always remember, nobody's a wizard here. Nobody knows where the market is actually going. We all trade based on probability. We all trade based on data and consider probabilities always. Um, you can have coincidence where your analysis is amazingly accurate, but trust me, on a longer time frame, try to use your analysis on 1 year worth of data, and you will see it's never always consistent. So if you have a eureka moment where you feel, oh my god, I'm an amazing trader, always look at it in a more humble perspective, I would say.
Yeah, it can also happen that you're just unlucky. For example, you have correctly identified the bottom, and then a news comes that you could not have foreseen and crashes your coin.
A
the
lot
day
of the
was
times.
the bottom, and somebody announces the news, and your coin drops because of a new news that you could not have foreseen.
Correct. So a lot of the times, a lot of hedge fund managers and a lot of hedge funds, when you present strategies to them, and I'm talking on the institutional level, what they try to understand is, are you just lucky or do you have a real strategy? And this is a very big key core question that a lot of smart hedge fund managers ask directly. If your strategy is purely luck, or are you actually with something good? Because if you actually have something good, there's a lot of money in the world ready to be deployed behind your strategy once you meet the right people. But most people just try to see if it's just luck or is it really a good strategy. Always have a strategy. If it's a good strategy, most of the time, it's going to be very easy to explain. It's going to be straightforward, or you're going to be able to, even if it's complex, you're going to be able to explain it in a very simple way that even somebody who doesn't know Python or XYZ will be able to understand it.
Absolutely, because you have probably initially thought of it in a simple way, and then you've made it
Correct.
more complex, and then yeah,
Correct. Correct.
coding
So
is
that development phase, correct. So
yeah,
that development phase of the strategy, it starts out simple, then it becomes complex, 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 complex. If because you have gone through that, you are able to explain it to anybody in a very easy manner who at least has some financial data or has some
yeah.
experience in trading at least. I'm not saying you're going to be able to explain it to a child or
Yeah, of
or a
course.
mom or dad. My perspective was like, since because your viewership is retail, so I'm just saying it's not like you guys can explain it to your mothers or fathers, but you should be able to explain it to somebody who is a trader in a very easy
Unless
way.
your father is also a trader.
Yes, of course. I mean, definitely, definitely, the probability exists.
Yeah. Okay, I think this was it. It was yeah a pleasure to have you here with us today, Siddesh.
Perfect,
Thank you very
perfect.
much for joining our podcast. It was really insightful, and we learned a lot from you. And yeah, I hope our users are just as happy hearing you as we were today.
Thank you so much, and it was very, very, very good to be here. I hope I was able to add value towards your podcast, and hopefully, it goes well. Thank you so much for having me.